Tokenomics is a crucial aspect of the cryptocurrency world, encompassing the economic model and monetary policy of a crypto token or asset. It defines how tokens are created, distributed, and managed within a blockchain ecosystem. Understanding tokenomics is essential for investors, as it directly influences the value and utility of a digital asset. So, what is tokenomics? Well, it's a combination of token and economics, referring to all the factors that make a cryptocurrency valuable and attractive to investors. And trust me, understanding tokenomics is crucial for anyone looking to invest in crypto. After all, you don't want to end up like me, a sucker for a good tokenomics story, only to find out it's just a pump and dump scheme, or should I say a token effort. And remember, I am not a financial advisor, and everything mentioned in this video is for informational and entertainment purposes only. Always do your own research before making any investment decisions. Now, before we dive deeper, let's clarify the difference between coins and tokens in the context of tokenomics. A coin is typically the native cryptocurrency of a blockchain, with Bitcoin being the first and most well-known example. Every coin created afterwards shares a lot in common with Bitcoin. Every coin has its own blockchain. Whether it's proof of work, proof of stake, or any other consensus mechanism, almost all blockchains must mint coins each block to pay mining or staking rewards, ensuring blockchain security and decentralization. Coins used as payment for network fees. In some blockchains, like Bitcoin, 100% of fees are sent to the miner or pool that mined the block. In others, like Ethereum, a large percentage of fees are burned, counteracting the minting that occurs as a block reward, and in some cases, leading to a reduction in the total coin supply over time. Another common use case for coins is staking. Most blockchains are proof of stake, a mechanism that is beyond the scope of this discussion. Let me know if you want me to make a video on this topic. In short, investors can lock a certain amount of coins to participate in new block creation, similar to running a miner on proof-of-work networks. On such chains, staking locks a significant percentage of total coins in circulation. For example, as of August 2024, 1/3 of Ethereum's total supply is locked in staking. It's like a committed relationship. You're locked in, but it's worth it for the rewards. Just don't expect any romantic getaways or candlelit dinners. Tokens, on the other hand, are a more recent invention than coins, as they require an existing blockchain to operate. First tokens, called colored coins back then, were created on Bitcoin blockchain, but due to the absence of smart contract functionality on Bitcoin, they had limited utility. Then came Mastercoin, later renamed Omni, which became the first blockchain to host USDT, and the two summarize, tokens are built on existing blockchains and can represent anything: assets, governance rights, bonus points, or the latest memes. On the plus side, tokens do not need to emit new tokens to pay for blockchain security. These days, tokens are easier to create and trade than coins, and there are far more new tokens than coins being created. So, how do we evaluate the value of a coin or a token? Well, it all comes down to market cap, the quantity of tokens in circulation multiplied by the price of the token. This means that if more tokens are issued or unlocked, either the market cap must increase or the price of each token will fall. That's why it's super important to investigate future token unlocks and issuance, aka token inflation. And speaking of token inflation, did you know that a large percentage of tokens experience significant inflation during the first year or two? It doesn't mean those tokens can't appreciate in value, but it's a significant headwind. Now, let's talk about initial token distribution. This is where things can get really interesting. Common allocation categories include public sale and airdrop, team or founders, advisors and marketing, treasury or ecosystem fund, and private or early investors. Airdrops are usually unlocked from the start, but some might be distributed later in second or third waves. And let's be real, most of those newly dropped tokens will be dumped as soon as possible. Founders tokens typically have long locking periods to ensure the team has skin in the game, while advisors and marketing folks usually get a small allocation that'll be sold quickly. And then there are early investors, aka venture capitalists. They're the ones who got in early and cheaply. Very likely that they have already made significant gains on their investment, and will sell immediately when their tokens are unlocked, regardless of the price. Anyway, if there's a really large unlock of tokens designated for early investors, my crystal ball is showing token dumping a few days to a couple of weeks prior to the event. Because let's face it, market participants don't trust venture capitalists to hodl. So, what are some general red flags to watch out for when it comes to tokenomics? Excessive allocation to insiders, short or no vesting periods with a large token unlock approaching, lack of transparency concerning token allocation, emission schedule, and the usual scam token red flags, like an admin's ability to print unlimited tokens. Sounds like a recipe for disaster or a therapist's couch. My cryptocurrency killed itself with irresponsible behavior. Just saying. Now let's revisit staking, a crucial aspect of tokenomics that we touched on earlier. As we discussed, staking is a mechanism that allows investors to lock up a certain amount of coins to participate in new block creation, similar to running a miner on proof-of-work networks. But what does this mean for tokenomics? Well, staking has a significant impact on the circulating supply of coins. When a large percentage of coins are locked up in staking, it reduces the amount of coins available for trading, which can lead to increased demand, and in turn, drive up the price. This is why staking can be a powerful tool for investors looking to generate passive income and potentially increase the value of their holdings. However, it's essential to understand the staking dynamics of a particular coin or token before investing, as it can also lead to decreased liquidity and increased volatility. So, if you're considering staking, make sure you do your research and understand the potential risks and rewards involved. After all, you don't want to end up exposed without a solid understanding of the market. Ethereum isn't the only one having fun though. Let's talk Chainlink, or as I like to call it, Linky goodness. Chainlink is that bridge between smart contracts and real-world data. Node operators retrieve that data and perform computations. But here's the kicker. They gotta stake Link tokens as collateral. If they're naughty, they lose it all. It's like a kink game's collateral. Play nice, or else. And who doesn't love a little kink in their investments, am I right? After all, being tied up in a good investment can be fulfilling. Yield farming and liquidity mining. Yield farming involves providing liquidity to decentralized finance, DeFi platforms in exchange for rewards, often in the form of additional tokens. Let's take a look at Curve, a decentralized exchange optimized for stablecoin trading. Users can provide liquidity to earn CRV tokens, which can be staked for governance and additional rewards. It's like a never-ending cycle of love. You get CRV tokens, you stake them, and then you get even more rewards. This creates a strong incentive to hold CRV tokens, because let's be real, who doesn't want to benefit from both liquidity provision and governance participation? Now, let's talk about deflationary mechanisms. Some cryptocurrencies incorporate these mechanisms to reduce supply and potentially increase value over time. Take Binance Coin, for example. They regularly burn a portion of their supply, reducing the total number of tokens in circulation and potentially increasing the value of remaining tokens. In conclusion, cryptocurrency coins and tokens offer a wide range of use cases and tokenomic incentives that encourage users to hold and hoard these digital assets. By understanding the underlying tokenomics, investors can make informed decisions about which cryptocurrencies align with their investment goals and risk tolerance. So, which cryptocurrency will you be taking home tonight? Thanks for watching this video. Make sure to subscribe if you haven't yet, hit that like button, and I'll see you soon.